All right, so we're going to begin this chapter on monetary policy by looking at what constitutes the demand for money. So, interestingly enough, we can use our supply and demand model to look at the supply and demand of money. And in fact, that's exactly what we're going to do here. Um, so, what makes up the demand for money? Uh, what creates a demand for money? So, in order to see how the Fed's monetary policy actions have an impact on the economy by influencing interest rates, we first need to understand how much money people want to hold, which is basically the demand for money, or which constitutes the demand for money. So, as it turns out, all flows of non barter transactions involve a stock of money. In order to use money, you have to hold money, in other words, right? So if you want to be able to go out and buy something, you have to have some money in order with which you can buy it, right? So in order to use money, you have to have some stock or some source of money, right? Now, people have certain motivations that cause them to want to hold money, right? And you should hopefully be able to relate to this yourselves. So, in other words, there's different types of demand for money. There's the transactions demand. So, this is the desire to want to hold money so that you can use it in transactions. So, this one you should have no trouble relating to. There's also a precautionary demand for money. And since you are young individuals, you may not be able to relate to this as easily. Maybe you can. But you could probably talk to your parents about this and they would be able to relate to this better. But it's basically a sort of emergency fund, right? Putting money aside in case bad things happen and you need money, right? That would be a precautionary demand for money. And then there's asset demand for money, which is having a stock of money in order to purchase assets like stocks, houses, cars, those sorts of things. Okay, so let's define sort of what we would consider a stock of money balances. So, like it says here in the slide, it's synonymous with just the usual term money or stock of money, money stock, or money holdings. These are all the same ideas, right? What are your money balances? It's however much money you have in your possession at any given time. That's your money balances or your stock of money. All right, it's transactions demand. Like I mentioned, this is holding money as a medium of exchange to use in making payments. Um, and the level of transactions demand will vary, and it's related to nominal GDP. Okay, so um, it really depends on the size of economic activity, basically. So when the economy is really chugging along and picking up steam, transactions demand for money increases. And then when the economy contracts and there's not as much economic activity, transactions demand for money decreases. And then precautionary demand, like I said, is the holding of money stock or money holdings in case of bad times, in case of emergencies, anytime that an unplanned expenditure needs to be made. So this could be for, um, you know, medical purposes, times when the economy has gone into a downturn. So kind of like what we are experiencing right now. With the economy shutting down more or less, people hold some amount of money for when there are unexpected bad times, basically. So that's precautionary demand. And then asset demand, that's holding money as a store of value, such as in a stock or a bond or a savings account, instead of holding it for transactions purposes as a medium of exchange. Okay. So when you hold your money in a bank account or a savings account, you're using it in a sense in an asset demand way. All right, so now that we kind of understand what underlies the demand for money, we can talk about the demand curve for money, right? The demand for money curve. So assume that the amount of money demanded for transactions purposes is proportionate to income, right? So as incomes go up, the demand for the transactions demand for money also goes up, and vice versa. When incomes go down, transactions demand for money go down. Could be that precautionary and assets demand are determined by the opportunity cost of holding money, which turns out to be the interest rate for the most part. So these are the sort of underlying things going on in the demand curve related to these different aspects of money demand, right? So again, transactions demand is going to be related to how much income people are making, and precautionary and asset demand are going to be related to the what has to be given up in order to hold those things in a bank account, for example, right? So both, precautionary and asset demand can sort of there's a blurry line between them. They can kind of be the same thing, in fact. So when people save money for emergencies, a lot of times it's in a banking account or a savings account or even in a stock or bond. And so these things, the distinction between them can actually be blurred somewhat. But in any case, by putting your money in some sort of store of value, you're giving up the opportunity or rather, you're engaged in the opportunity to earn interest on those things typically. Whereas if you spend it, you're giving up that opportunity. So the amount of money that you want to store, either for precautionary purposes or for asset demand purposes, is going to be influenced by what you can get in terms of interest payments by keeping it in a savings account or in a bond or a stock. Okay, and so just like all the other demand curves we've seen, the demand for money is really no different. It's a downward sloping curve, and we still have quantity and price here. So remember that interest rates, that's simply the price of either borrowing or lending money, or in this case, really keeping your money in something other than, under your mattress, right? If you put money into a savings account, a lot of times that pays interest. And so you're being paid a price for basically providing your money to the bank in order for them to lend it out, right? So again, recall that the interest rate is simply a price of borrowing or lending money. And here we have quantity still on the x-axis. So it's really no different than any other demand curve we've seen. We've got quantity and price, and it is downward sloping. Okay, so let's take a look at an example regarding the demand for money. Interest rate movements in U.S. companies' cash holdings. So between 2006 and 2009, annual interest rates that companies could earn from holding U.S. Treasury securities, which are bonds, dropped from between 4 and 6% to less than 1%. So they were, in other words, were getting less in return for holding bonds, which is a way to hold money either for precautionary purposes or asset purposes. And consistent with the theory of the demand for money, cash holdings by the 500 largest corporations together rose from less than 0.6 trillion to more than $1.2 trillion. Okay, so in other words, as the price of lending money went down, they held more cash, right? So basically, what's happening is, right, the corporations have a choice to make. They can either hold cash, cold hard cash, which doesn't return any interest, or they can put that cash into a bond that pays them money. Now, as the payment that they got for putting that money in bonds came down, there was a lower incentive to hold their money in bonds, and so they held more of their money in cash rather than putting it into bonds, which were paying them less money than before the interest rate went down. So basically, we see here in action the fact that the demand for money slopes downward. Okay, as price of lending goes down, the quantity of holding cash goes up. So there you go.